Awesome. How's the audio?
Sounds good.
Splendid. Do guys however you like. Fundamental problem of the capitalist market is that of the principal agent. That is, the incentive of almost every shareholder is to create long-term value. Think about the fact that most companies' shares and most companies are owned by pension funds, people that are providing for people's long-term retirement, their long-term future. They're provided by wealth management or asset management funds, which are people who care in the long term about their ability to fund their lifestyles, fund their retirement, fund their children's education. But those shareholders are unable to themselves run a company. So what they have to do is appoint management who will then be compensated for running the company in the ways they desire. The problem that occurs is that management's incentive overwhelmingly is short-termist, because the compensation schemes that have been devised for management, compensation schemes like pay packages, compensation schemes that allow them to get issued short-denominated short stock options, those schemes allow them to engage in a bunch of behaviors that maximize their compensation in the short term, but decrease the long-term value of the company. Think about the management that issues short-term stock reports that inflate their current numbers at the expense of the long-term viability of the business. Or private equity firms who can take over companies, strip their assets, which makes the PE firm an enormous amount of money in the short term, but which leaves the underlying company, things like Thames Water, things like essential industries, in a far worse position. We think it would be a better world if this issue was resolved by simply skewing incentives of executives, of management, into a more long-term direction. On setup, we just support the things in the info slide. I think there's not much more that needs to be explained beyond the motion. All I would note is that when we talk about things like minimum holding periods, that's obviously not for everyone who owns shares. It is for executives who own shares. So people who are being issued stock options will be issued minimum holding periods in that company. Think about, for instance, the Australian case of Drone Shield, where people were issued a lot of shares, executives were issued them, and then they immediately sold them off and they had no incentive to operate within the company. We also think that the things we defend in this model are likely to be things that shape the norms around how companies are managed. So increasing amounts of long-termist policies from the state will create norms around the ways that shareholders expect companies to be governed, norms around the ways that executives expect their compensation to be accrued into the future. First argument, we think this redresses a short-term bias. First thing you want to do is explain why it is very, very easy for executives, when their compensation schemes are short-termist, to juice the short-term value of the company or juice the short-term compensation they get without bringing long-term value. There are 4 ways they can do that. First thing they can do is they can bring forward orders. It is very, very easy for executives in reporting requirements to bring forward the amount of orders that are being issued over time so as to currently juice their stats now, even though that means those orders will not be tracked for in the future. Second, you can mess around with the depreciation of your assets. That is, you can list your assets as more prone to depreciation, but having a higher initial startup value, which explains that the assets you have right now are very valuable, but the future assets will be seen as less valuable. Third thing you can do is you can sell off the assets of a company, which is the strategy of many predatory private equity firms. Their strategy as a company is explicitly to take over firms, maximize their short-term compensation, their short-term value by selling off and stripping those firms' assets and then depreciating them into the long term. Finally, you can burn off the long-term value of your company in ways that make you profit in the short term. And I think many of these are very intuitive to consumers. Think about the ways that companies engage in enshittification, where they cut the quality of their services and raise the prices, which in the short term makes the products cheaper for the company to manufacture and the profit margins higher because consumers are paying more, which in the long term reduces investor trust. Think about the ways that companies can ruin their relationships with their own staff, with other employees, by doing things like paying them less, by doing things like breaking down their relationships with suppliers, which will make them profit now, but in the long term be bad for the company. The problem with all of these things is that none of them are in fact value producing. All of them juice the short-term value of the company. They're good for reporting requirements, but they're not good for the long term. How do we resolve that problem? With 3 strategies. First, when compensation is long-term, that is when executives are being paid out in, I think the most likely way is long-dated stock options. So 3 to 5 year, 10-year stock options. When they're being paid out in those long-term stock options, executives' compensation incentive skews towards the long-term success of the company. They do not engage in those bad behaviors we described previously because that is no longer in their incentive. Second, when you reduce the reporting frequency, you reduce the pressure on people to report short-term profits. Think about the ways that even a not high enough profit increase for many tech stocks led to massive declines in their value, which is why those tech stocks promise all sorts of bullshit, like OpenAI, who constantly promise that they're going to spend $100 billion on a large data center that will successfully create AGI by 2027, because they have to. Otherwise, the overall value of the company will decline, which is bad for their compensation. When you have a longer term reporting future, you're more able to engage in long term policy. And of course, there are still checks on that long-term policy. Think, for instance, about the fact you will still be reporting to the board, but those checks are nowhere near as likely to force you to be short-termist. Finally, when executives are subject to minimum holding periods, it is far harder for them to divest their assets and lead to harms. Why is it good to produce long-term value? 3 things. Firstly, the long-term value of the company is enormously important to a great set of actors that you should care about. Many people own assets in pension funds. They are not merely the wealthy. In countries with mandatory superannuation, almost everyone has assets invested in these companies. Second, the products that these companies deal in get better when they're more long-termist. They are cheaper because those companies are more focused on reducing the long-term cost of the product, which builds their relationship with their consumers, but which may hurt their short-term bottom line. They are more high quality because that is what increases people's trust in that company and like of that company, even though it is bad for the short-term bottom line. They do things like care more about their relationships with other stakeholders, which is good for their employees, good for other companies. Yes, closing.
The long-term equivalents of these incentives are just as bad on profit motivation, as in shrinkflation is an effective way to maintain demand into the long run. Private equity firms already have holding minimum periods of like 8 to 10 years, so selling for parts only happens when it's just the best thing to do. I'm unclear why making it more long-termist solves those types of problems.
The second thing doesn't make sense because if private equity firms have minimum holding periods, then the stripping of assets would be impossible. So the fact that they are not doing that is not like de facto proof of that. The first thing is the long-term problems you describe are problems that also affect the compensation value of in the long term, right? Like if you have a long-term thing, shrinkflation will continue to hurt your bottom line into the long term and the short term. The problems we describe are things that uniquely hurt your short-term value. Finally, we think this makes financial markets substantially less stable. And the reason that markets are less stable when they're short-termist is threefold. First, they're more vulnerable to bubbles because when you have shorter term reporting schedules, you're more likely to engage in misleading financial reporting. Think about AI firms who engage in this kind of reporting all the time because companies like Anthropic and OpenAI are required to provide reporting every few months. And in those reportings, they're required to produce new evidence of their ability, new things that can drive up their profit or share price. That means that they are constantly promising more, which is exactly the kind of speculative behavior that leads to bubbles. Second, you're more likely to have succession crises on side opposition. Things like the crisis currently afflicting HSBC, which has been unable to find a chair. Those sorts of short-term problems where a leader suddenly steps down and there's no one to replace and the company goes under are far less likely to occur when you are forced to make long-term planning. Thirdly, there's less likely to be less asset stripping. There's less likely to be leveraged buyouts from companies and private equity firms in ways that deteriorate the quality of the businesses in the underlying sector. That is, of course, a benefit we are very, very happy to stand behind. Proud to open government.
Great. Hello.
Am I audible?
Yeah, you are.
I want to start off by saying that I think there is already existing incentives for investments to occur in the long term. First of all, most investments are already long-termist. So per the nature of the pension fund, where you have to pay back money in 40 years, or for things like index funds, or for things like venture capital, which are making angel investments that you expect a return for in 20 or 30 years. All of these different kind of investments are already the long-termist and is already something that firms can gain access to. Secondly, I think there's generally aligned interest between long-term and short-termist goals. So oftentimes it is the case that investors also want a greater return in the future. Investors also see growth potential inside a company. So it is unclear why it is necessary, why it is good for the economy on a macro level when investors have to lock in their funds when something is when the value of that particular stock or company is already going down and when they don't see growth value inside that business. We think in the case in which short-term and long-term incentives are aligned, that is something that is good. Note that there's already long-term measures to increase investments in the first place for that companies take to be able to increase investments. So this looks like how in the AI industry, currently no company is really profiting, but they're still attracting large numbers of investors that are willing to invest in them because they see that growth potential. All of these suggest that there is already incentives for investments to be long-termist, but it also just suggests that in the particular industries such as tech startups, where you most need this sort of long-term investment, that is something that is already happening. What government needed to show is that that there is a crisis in the status quo, that in the status quo somehow the economy is fucking up because the companies are being inherently short-term because investors are being inherently short-termist. I don't think they have fulfilled this burden. There's then going to be three arguments coming from opening opposition. The first is on why there's worse investments on their side of the house. The first thing I want to note is that they greatly harm hedge funds on their side of the house. The reason for this is because hedge funds profit from short-term market movements. So what they do is they spot companies that are overvalued and then they short them up, or they buy companies that are undervalued and then they expect it to go up soon, and so they buy this. What this requires is they need to be able to recycle capital quickly. So they need to rapidly be able to exit bad investments and then move on to better ones. They need to recycle that money so they can fund new startups. What this means is that they heavily rely on speed. Under their side of the house, when you force these companies to hold on their capital into firms that are not working or firms that do not align with their strategy, that means they cannot do things like reallocate their assets. It means that they cannot do things like take short-term price signals and then exit the market when they don't think this is working. All of these suggest that hedge funds will just have significantly less power and have significantly less money. Some of them will start dying out. This is extremely bad because it most hurts things like startups, hurts things like small businesses, things like innovative tech sectors, and basically hurts any firm that want to issue new shares or new bonds. But the impact of this is that, first of all, know that pension funds also get worse deals because they have similar investment portfolios. So when the market becomes more controlled, it means that pension funds are also forced to lock into long-term investments that are oftentimes bad for them. And this is bad because this is the most stable form of investments that exists. But secondly, know that if this is a policy that exists in a singular country, hedge funds will also just try to move money offshore and so far as they no longer see this country as something that is worth investing in anymore, which causes things like capital flight and is generally less good for the economy. Now, I think I think what the conclusion you should draw here is that there is significantly less amount of investments, particularly in the industry that you need them. I think the weighing here is that the quantity of investment is oftentimes a lot more important than the decision making that happens within the company. And the reason for this is I think decision making is something that is relatively marginal or symmetric on either side because the company has decision making individuals. It has an executive board, and these are individuals who have leverage power to negotiate with the investors who expect returns on the short term, but also have some interest on the long run. So what this means is that decisions won't be made so poorly on their side of the house anyways. The change in how the quality of the decision made is marginal. What we think is important is the fact that you get investment into various different startups in various different industries, which means on a macro level, there's more things like competition within an innovative sector, which encourages companies to innovate, and that leads to better macroeconomic outcomes in the long run. Before I move on, I'll take a point from closing.
Largest hedge funds like Citadel and Jane Street don't put money into startups. They trade on bid-order spreads and find arbitrages that make the cost of equity slightly higher for the average retail investor. That's bad.
So that's probably like all of my mechanisms apply symmetrically to any other business, even if we're not talking about startup. But this also affects every other form of investments that's not hedge funds. So all the mechanisms cross-apply equally. Secondly, on why we think flexibility is just better for decision-making economically. The first thing I will point out is that the government is probably really terrible at this. This is because each sector has different optimal horizons. They have different time spans in which that is optimal for investments to occur. So, for instance, in a tech startup or the retail sector, it requires high amounts of flexibility around short-termism. It requires the rapid change in where capital is allocated. So all of these means that on their side of the house, capital becomes trapped inside long-term commitments, and that is often bad because when investors see signals that a firm might be unsuccessful, or when it is a sunset industry, they're not able to pull out their funds quickly and reallocate it somewhere else, which we think is generally something that is extremely terrible for investments and for the economy. But lastly, I want to talk about why they get worse corporate decision making on their side of the house, because I think that oftentimes CEOs are able to justify capital. CEOs are forced on our side to justify their use of capital because they need to prove that it is something that is good in the short term and good in the long term. On their side of the house, they often invest into projects simply because it is able to hide their poor performance because they still want investments to keep going in. But second of all, know that I think it is exactly the short-term pressure that forces companies to make good long-term decisions. The reason for this is because short-term scrutiny from analysts and from markets is what stops them from doing long-term projects that sounds promising in the status quo. So things like empire building acquisition, things like cutting wasteful R&D that basically has no prospect but looks good for the investments of their reputation. All of these things are things that we're able to hold them accountable for because we make sure they're spending money properly. Whereas on their side of the house, they can claim that there's some long-term value attached to it, and the company ends up being more likely to fail in the long run. But thirdly, I also think that oftentimes these long-term projects come with extremely high risk. On their side of the house, when all of the corporate decision making goes into the long term, you end up sacrificing the short-term survival of these companies. So oftentimes it is extremely ambitious commitments. That means that these companies are more likely to fail when you allocate your capital in that particular way. So the impacting here means that things like startups, things like SMEs are going to die faster. They're going to be forced to invest money into R&D that doesn't get them payback in the short run. All of these means that companies are far more likely to fail on their side. For all these reasons,
Great, DPM.
The thesis of opening government in this debate is incredibly simple. In the long term, the only way to generate profits is by consistently providing value to your customers, is by treating your suppliers and your employees well, and is by ensuring you don't generate outsized externalities upon the world by, say, destroying the environment. Because in the long term, all those things catch up to you. If your products are bad, people will go to other companies. If you screw over your employees, they will go to other companies. If you treat your suppliers badly, they will work with other people. In the long run, if you're profitable, it is because you're providing value to the other people you interact with. Unfortunately, in the short term, that isn't true. Because in the short term, it's very easy to lie, to trick, or to just, you make use of the frictions and stickiness inherent in relationships to abuse and exploit people. Think about how Donald Trump, when he was in business, repeatedly would just stiff over his contractors and refuse to pay them. And the reason you get away with that is people learn after the third or fourth time, but they probably don't the first time. You can probably scam people for a fair bit. You can probably juice your numbers in the short term by jacking up your prices or making your products worse. And it takes time for people to catch on. Considering that, the question of this debate is, should we evaluate the management of companies on the basis of whether or not they're producing profits in the short term, which might be the result of good business decisions, but might be the result of, for example, decisions that destroy long-term value, or should we wait for the longer time frame before we determine whether or not that manager has done a good job? And yes, opening opposition is correct that in some circumstances, the same decisions that are good in the long term might also be good in the short term. The question is, are all decisions that are good in the long term good in the short term? I think not necessarily. Sometimes you have to lose a bit of money in the short term to make money in the long term. But secondly, and importantly, the things that juice profits in the short term are often easier than the things that create long-term value, and they often create more short-term profit than the things that are good in the long term, which means that when you evaluate people on their basis of whether or not they produce short-term profits, their incentive isn't to do things that produce long-term profits, because one, they might not produce short-term profits, and two, even if they do, they'll produce less profits than easier things that produce more short-term profits, but are in fact bad in the long term. And that is not responded to at any point by opening opposition. So let's deal with the arguments they give. The first argument they say is that it's important that hedge funds are able to recycle capital quickly in order to ensure that capital allocation within the market is relatively efficient. The first question I have is, how is this affected by the debate at all? As Jack sets up pretty clearly, this is a debate about the way in which we treat executives of companies. Hedge funds are not executives of companies. If they want to buy and sell stocks, if they want to engage in shorting or arbitrage or whatever, that is obviously fine. That is part of the debate. They're allowed to do that. So this is just entirely orthogonal to the question of this debate. But secondly, even if that was not the case, the question I would have is it always the case that hedge funds, for example, are aware of whether or not a firm is underpriced or overpriced in the short term? We would say in many instances, you require the long-term view to determine whether or not, for example, a firm is full of shit or whether or not they're telling the truth. Finally, they say hedge funds will flee from countries engaged in this policy to ones that don't. But obviously, this policy would just occur everywhere. So it's unclear where the capitalist flight occurs to. This argument doesn't make much sense in that particular circumstance. The second claim is that this will result in worse corporate decision making because they say, well, it's good to check in on people more often rather than just checking on them once in a while. Because what if they get up to something that's kind of suspicious? But Jack preempts this in three ways. The first question we have to ask is, just because something looks good in the short term, does that mean it will be good in the long term? And vice versa. Just because something looks bad in the short term, does it look good in the long term? We would say that sometimes yes, sometimes no, but that is why we should evaluate on the long term. And it's not like, managers just get to do whatever they want and then you ask them in 15 years, did you lose all our money or are we billionaires? Obviously, they need to present business plans, justify why they think the project will pay off, explain how much money they think they'll lose in the short term, explain why they're on track to those projections, etc. So it's not like we just totally leave them alone. The question is, if they lose money in the first year or two, we don't say, oh, you're failing, we're going to fire you. We say, okay, well, you're losing money, but it seems like this is what we had planned to make money in the long term. That's fine. Let's continue to do that. And if they're losing far more money than we expected, then yeah, you could still be like, this doesn't seem like it's on target for what we want in the long term. And you could still tell them to drop the project or fire them where needed. Secondly, though, we point out that management wants to make money in the long term. A key premise of opening opposition's claim is like, well, this will just allow management to kind of burn money. But like, why would they want to? Their compensation is based on generating long-term profits, which means that their incentive isn't just to do like random empire building. If that isn't good for the long-term profitability of their company, they won't do it. And in fact, the opposite is far more often true. Think about how, for example, merging lots of firms together looks really good in the short term because you're like, oh, we've got so much synergies and, we'll have much more market efficiency. But in the long term, it turns out that doing like lots of acquisitions often just burn capital and reduce your efficiency. It's far better to evaluate that over the long term rather than allowing someone to say in the short term, it'll be really good. But finally, you obviously just still need to explain how all of this works. So I don't think that is very effective. I'll take closing.
Yeah, I think I'm unclear on the margin of your impact because even in your best case, you still need to turn a profit every year. What long-term plans turn a profit every year?
Sorry, no, you don't need to turn a profit every year. Like you guys have just misunderstood the debate, right? Just because the reporting period is every year doesn't mean that in that report you need to generate a profit. This is obviously a normative shift, one metric of which is reducing the frequency of the reporting period, but many other metrics of which are just understanding that profitability occurs over the longer term. I think you've overemphasized one part of the info slide, and that is probably to your detriment there. So obviously, people would be more accepting normatively of the idea that profitability takes time, which is the key difference. The final claim opening opposition makes is just to say there's already incentives to care about the long term, so you don't need this. But note, the incentives they talk about are firstly venture capital, which is the exception. It's a very small part of overall capital markets. Less than 0.1% of funding goes through VC. And yes, they care about the long term because they're making huge numbers of diversified bets where only one needs to pay off. The important thing is that the vast majority, for example, companies in the S&P 500, which dwarf the total number of firms in the S&P, feel the need to demonstrate profits on a much shorter timescale, whether that's every 3 months, every year, or so on. And we say that is the problem because they engage in things that are bad in the long term, but good in the short term. They destroy the environment, even knowing that they'll be forced to pay fines for that in the long term, or they break the law, even knowing it'll be bad for them, or they make their products worse. They outsource, they screw their employees, knowing that in the long term, those things are going to crush their ability to do good business because it allows them to juice their profits, because it means management gets bigger paychecks. They don't care what happens in 10 years because they'll be gone. That is precisely the problem that we get rid of. And there is no sufficiently strong incentive to do so. And this is crucially important. Like what we want to incentivize people to do is create products, innovations, technologies that make everyone's life better. What we don't want them to do is reward people for moving numbers around in a way that often destroys value, often makes people's lives worse, but that doesn't actually create value. For all those reasons, incredibly proud to govern.
Great, Dilo.
Government has, I think, unfortunately set up the wrong debate. This is a motion about corporate investment culture. That is the culture that affects corporate investment, what exists within the market. So clearly the arguments we are running an op-ed, that looks like both back half teams are going to run, is about how corporate investors are affected by the policies that they talk about. I would notice then the things they have to stand over by the motion, minimum holding periods, long-termism, and how you pay people back, are things that affect investment funds, the investors within the market of corporate investment. It is not about the profit-making models internally within companies, but about the regulations you said about how people can invest and the culture surrounding that investment. I think this is a clear read of what the motion means. I think the model that Jack has set up is, I think, quite unfortunately, the wrong one. So the first question I want to answer then is, who is affected by these policies within the market? It is not the managers that they talk about, though I will engage with the managers of existing funds later on in my speech. And it's also not several other actors. Firstly, it is not pension funds, because pension funds operate an extremely long-term model. Their entire business model is based on the idea that they can pay you back in 40 years for the money that you've paid plus interest. It is also not index funds who invest on are pegged to an index and are going to diversify and proportionally invest their money on the basis of where those funds are within that index. The only thing they changed to opening government for index funds is if a stock within that index hugely drops in value, the minimum holding period means that the index fund is much slower to react because they are unable to sell the stock at the time that they would want to, which seems bad for people's ability to make money and also for the index fund's ability to pay dividends and I guess fulfill their fiduciary duty to their investors. It is also critically not private equity, because CEO are correct that often they already have minimum holding periods, but I would also note the model that opening government are talking about being locked to executives isn't very clear then as to why this would affect private equity firms or the way that they would invest. If they want to only affect executives within firms, I'm quite unclear as to why private equity are unable to do these things. But also, they do hold on to them for some amount of time. It takes some time to determine how profitable a company could be and whether you should A, cut costs but make it profitable, or B, asset strip it and move on. So the distinction is it takes time regardless. I'm not actually sure why if you stay 8 months versus a year, it is very different to staying for I'm not sure what the difference is that opening government is standing over. And I would notice that private equity also acquires companies, so I'm quite unsure what regulations opening government is able to put in under this motion that changes that. I would also note it's not venture capital, which they concede. Their model is extremely long-term when you invest in 30 different companies. So the only actor within corporate investment that we think is affected is hedge funds. And we think that is relatively harmful within the market and for people. Where is it that hedge funds make money, and what are the business models that are going to be affected by this motion? Firstly, I think just their ability to short stocks is probably entirely gone, because the point where they can sell a stock that they don't own and then buy it back later on, probably less possible the point where you have minimum holding periods where you cannot do this quickly and react to the current price of that stock within the market. But secondly, they cannot trade on the micro short-term basis that hedge funds traditionally do. So normally what hedge funds do is they've got a lot of tactics to buy assets that are currently underpriced or make those assets underpriced and buy them back later at a correct higher price. They've various high frequency trading models which can allow you to dump a lot of stock, drive the price down, cause other people to dump a lot of stock and then buy it back very quickly at the lower price and so that you have more of it but you've paid less money. The thing is, they just cannot do these things. They cannot engage in these policies on opening government side. And the issue with that is that they just then cannot make as much money and the business model of these firms fundamentally fails. Why is this bad? I think there are fundamentally two reasons for it. One, because I think to some extent we should let people enjoy things. There are people with a high risk appetite who want to make money and they should be allowed to do so. If they want to invest in high risk, high reward funds like hedge funds, rather than the more stable investors that exist in the market, we should let them do so. It is something that people enjoy doing. It is something that people make money from. I think they should be allowed to. But secondly, because many different investors within the market diversify their assets and they have hedge funds as part of their portfolio because they're high risk and high reward. So you have a lot of lower risk, more stable assets, but you also have a few that are higher risk but can get you more money at the end of the day. That is why pension funds, for example, often invest in hedge funds as part of their portfolio because they want to make more money from it at the end of the day. That means on government side, pension funds also make less money in the long term, which is bad. Firstly, because we care about pension funds who are primarily paying back old people who we think deserve money and have and are better off to be able to get it. Secondly, people who have paid into the funds, they deserve to get their money back. They have an obligation and they've paid in. We think they deserve to get it back. But thirdly, we think people who deserve to have more money if possible. Like, they have not done anything wrong. They invested in a pension fund on the idea that they were going to get a large amount of money in the future back from them. Government takes away how much money they can earn because they take away the pension fund's ability to make money off of hedge funds. Even if, however, this is about the incentives of management, I'm not sure that opening government has been able to solve that problem. Firstly, I would say, as a manager in a firm, you are still trying to attract investment in the short term. You're trying to convince people to invest now because you maybe are going to make a profit in the long term. That means you need to make yourself attractive in the short term. So you're still likely to do large amounts of these policies to get people to stay. And additionally, if the point is that minimum holding periods mean that they cannot sell the stock, which I contend is the motion, then actually that just incentivizes you to do short-term things more because people are less able to sell the stock down the line. They therefore have to hold on for a longer period of time. So if you trick them now, they can't get out as easily later on. Secondly, I think the short term does lead lead to the long term, but at least the point of the payoff is the thing that these managers will care about. So if they are going to get repaid later on, if they're going to get repaid at the point where they're long-dated stock options repay them. We think that they have, if anything, an incentive to engage these activities at that point so that they can get the maximum amount of money at the time that they want it rather than now. I'm not sure it changes massively. They say that you kind of change the incentive by doing these policies, but I'm not sure that you do because the overwhelming urge of those within funds or within companies is to make profit, and the profit-making model of the funds we think are affected is to engage in this kind of extremely short-term activity. So we think this is not, the policies they're standing over to resolve this don't seem to solve that problem. Do closing government have a POI?
Yeah, so hedge funds can only be invested in by rich people. Famously, hedge funds, unlike pension funds, are restricted access.
Our point is that pension funds often also invest in hedge funds as part of that. Pension funds have a lot of money. So I guess in that respect, they are similar to a rich person in that they have a lot of money, but they have an interest in having a diversified set of assets that can get varying amounts of profit into the future. I would also note several other things that I'm not sure are able to change hugely on financial stability on the government case. So I think we contend that probably hedge funds being cut off from doing their model changes, but we think this is more bad than it is good. On bubbles, I think the issue is that there are exogenous causes of bubbles, so often just hype around certain things, which is why there's been investment in so many AI companies, but also signals that other actors are investing in these companies, which suggests that they're going to keep going up, are reasons that you invest in these companies and end up creating bubbles, even though they are overvalued relative to their underlying value, not because solely of the short-term reporting and things. So I don't think opening government solves this sufficiently, but I would also note that on things like lying on financial reports, I would suggest laws against fraud are more likely to be an issue here, but also that it is good to pressure companies to improve. It is good to pressure them to keep promising things and to make sure they're held accountable on a short-term basis as they continue to have to report back and have to tell you what they've actually achieved since the last report. So we suggest this just means that companies get checked in on more often, which makes them better and pushes them to be better. For all of those reasons, oppose.
Great, MG.
Okay, can you hear me?
Yep, you're good.
We think Martha's right, opening government misreads the motion, but we'll give mechanisms that cater to both sides of the debate. So our extension is very simple. This allows for important long-term projects and innovation from companies. Why is there a problem in the status quo? The first is that the discount rate on future cash flows is very high. So for example, if a company spends $1 billion today on green technology that is going to only start bringing in earnings in like 2035, the stock price drops today because the future gains from that are heavily discounted when using a DCF approach. And so what happens when this topic kicks in is that you change investment culture. So now when investors that are investing into that company care more about future cash flows because they have to hold on to those investments for a lot longer, they discount those future cash flows far less, which means that the stock price today drops less, which means that the company is less hamstrung in its ability to do those kinds of long-term projects. But also, quarterly reports are really harmful for long-term investment because when 4 times a year, so let's say like you're a company and you really want to change your supply chain to make it more sustainable, or you want to open up a big factory in a new city because that's going to be good in the future, but you have to take a short-term hit. Every single time you publish a quarterly earnings report, it shows that you're in the red. But eventually it's going to be a very good idea, but in the short term, you have to take a cut. Why is that really bad? It's bad because shareholders and investors freak out. One component of that is high frequency trading, which is like 80% of trading these days, right? Because the way that it works is it basically immediately reacts to the news, and all of these high frequency trading algorithms immediately like sell all of these shares because they think that they're losing money. Which means that the stock price drops because there's a mass selling. Like there's not just high frequency trading, it's like all shareholders that are like antsy about the fact that they're losing money, or like it looks like they've lost money on their investment. And so they sell their stocks, the stock price drops, and now the company has far less, or the company is hamstrung in kinds of investments that it can make, or the person that authorized that project gets fired, and so it's not in their incentive to bring it up in the first place. I would also just note ancillarily that we get rid of high frequency trading because if you have to hold a share for like a certain period of time, we just get rid of high frequency trading. And because of the POI that Tanush said about why this steals money away from pension funds, that's probably a good thing. But even in terms of the long-termist investors, they also panic when they see a quarterly earnings report that shows that their investment is in the red. Because firstly, even if they care about the long-term window, these like pension funds, for example, still want to pick companies that like turn a reliable profit over time. So even if they don't maximize the amount of money they make, they still want to invest in a company that is like making money every single quarter. And so they're unlikely to invest. So they're likely to divest from these kinds of companies that are making, that are taking a short-term cost in order to have a long-term payback, a project that pays back in the long term. But secondly, I would also note that like lots of shareholders aren't long-termist. Like pension funds, I own like, make up like 10% of the UK equities market. Like a lot of these shareholders are actually just people that like buy a share, wait for like 6 months to like turn up a little profit and then sell it. All of those shareholders are going to freak out and sell when they see a quarterly earnings report that shows them in the red. And oh yeah. And as I mentioned, it's in nobody's particular interest within that company to authorize those kinds of long-term projects, because if you are the person responsible for your share price dropping, you'll probably just get fired, which means that you don't authorize those kinds of things. So this proves that even if managers have an incentive to do those kinds of good long-term investments, they can't do it. This is a better mechanism for this impact than opening government stuff about why executives care more. Firstly, this is a literal capacity constraint, right? So it just shows that even if in the best case scenario of opening opposition, managers do have long-term incentives for long-term sustainability and profitability, they are literally capacity constrained and they cannot do those kinds of things, or they're heavily incentivized against it because they will lose their job. And secondly, this mechanism is more comparative because many executives we would know are around for a very long time and probably do want to make a stable profit in the long term, whereas this is a unique problem that only exists under their side, and we solve for that. Okay, what are some examples of this? It looks, for example, as I've mentioned, like companies making their processes far more green, like shifting to a renewable energy, so like shifting more and more towards renewable energies, which is incredibly costly in the short term because you have to change your supply chain and change like your operations and stuff and like, build whatever and like new pipes and shit. But it's probably something that's very good because it means that not only will the company make more money in the long term, but it's also socially utile insofar as we're empowering companies to move away from fossil fuels. It looks like pharmaceutical companies taking more time to do research and development and innovation for drugs that might be really, really difficult, but are incredibly socially useful, rather than just doing things like renewing patents or making like little short-term adjustments in order to make a quick buck in the short term. Why is this stuff really important? It's because these kinds of long-term investments are incredibly crucial. The biggest problems in society are the ones that usually require the largest upfront investment. And so, uniquely, our case unlocks the ability of corporations to invest in those kinds of things. And notably, this impact is better than opening government stuff on like, companies like spend more in the short term to inflate inflate how they're looking. Because like the upshot of that argument is basically that in the future, the company is going to earn less money or is going to be worth a little bit less. What we prove is that in the future, we get uniquely important and significant social benefits to everyone else. And I think that is larger on scale. Before I go on, opening.
It feels like hedge funds are the ones who invest in most of the things you care about, but you're also not letting companies sell stocks now or funds sell stocks for companies whose value dropped due to poor decisions because of bubble bursts or when retail investors sell en masse. You lock all of them into holding on to assets that have plummeted in value, which is bad.
Yeah. So I just think that like more plausibly, like sometimes bubbles will happen, and like Tanush can respond to this, but that seems like a very small minority of the time that the kinds of doom scenarios that you're talking about happen, whereas the kinds of things that we talk about, where on an every single day basis, investors are hamstringing the capacities of companies to do long-term innovation, that seems like a far more everyday and common occurrence, and in fact is like very socially impactful. And so I would say that on weighing, you should care about our stuff more. So now, versus opening opposition. They say the problem with a lot of these long-term investments is that they are high risk and we would prioritize short-term survival. We would say two things in response to this. Firstly, just on the weighing, we think that it's more important, for example, to let companies go green or allow companies to do like pharmaceutical research and development, because that's the kind of stuff that helps everybody. Whereas if a company fails, that might be bad for that specific company, but like on the weighing, I just think that's less important, right? Like we think that the companies that like are less socially useful maybe should go bust, and then the investors can invest in all of the really good companies that we care about. But secondly, we actually allow for company survival on our side of the house, because on your side, when companies or like when management brings up a proposal to do a long-term investment, the company dies because in the next 3 months you like publish a quarterly earnings report that says we've lost a bunch of money this quarter, and all the shareholders freak out. And that means that the company dies on your side of the house, whereas on our side, you actually allow companies a greater leniency to do the kinds of things that we think are crucial. For those reasons, I'm very proud to govern.
Great, Emma.
Brilliant. If I get POIs verbally, that'd be great. I won't be looking at the chat. On Gov, sometimes your quarterly earnings reports go red and investors freak out a little bit. But also on Gov, rather, you completely change the policy and don't let them know whatsoever whether it's red or green for the entire year until like December and the end of Q4. And then investors definitely freak out. The implementation of this policy creates really bad reactions. And we're going to talk specifically about where that already happens. Because a lot of the problems that opening government identify are just already solved problems, because the board who hires and fires the CEO and other executives, they care about the long-term interests of the company. And that means that they often impose these policies already insofar as they're advantageous to their long-term stakes in those companies. So they do things like they have vesting periods for shares given to employees of the company, or they have long-term compensation plans for the CEOs and other high executives, like is actively happening for Elon Musk right now. That means that we can totally take opening government and their model that they give at complete face value, unlike other teams in this debate for some reason. But what we can also identify is that the only time that these policies that are implemented by a government that make companies do this, the only time that those are relevant and manifest is in those instances where they wouldn't have imposed these long-term policies anyway. That already heavily marginalizes a lot of the impacts from government bench, because in those instances where they're right, then the long-term stakeholders who get to actually decide who the executives are and what decisions they're making will impose similar types of policies in those places. Where doesn't this happen, and therefore where does this debate take place quite a lot? We think that's often true in developing countries, where you're much less likely to have these long-term types of controls for a couple of reasons. Why do investors react to this policy in those areas, and why are they especially skittish of this kind of thing? In these developing countries, there are two main concerns that mean that external investors are usually skittish and they're willing to pull out investment if anything happens. That's A, because of a fear of capital controls, like you're worried about getting your returns out of the country, different currencies, currency fears, stuff like that. And B, because of liquidity concerns, like can your returns actually manifest if you do pull out? Like are there people who will buy the stakes that you have overall? Those two reasons mean that if other teams say, but why is this the tipping point to divestment? Why are these policies what change it? Well, there's your tipping point. People are already existingly skittish, but are willing to get the returns that you might get in these places. When you totally change these policies in ways that seem intransparent, in ways that seem like they're logging down your investments, you're much less likely to actually have those important external investors continue to invest in those companies. But go for it, Jack.
Per page 34 of the manual, challenges to the definition must occur at LO, not DLO in Gov member, OGF definition or fiat, and it is clearly a reasonable definition of investment culture to talk about the ways investments are managed, which is what is the motion about in the examples that are given.
Yeah, sure. And we're engaging on this pretty directly, so fine. You can POI both the other two teams. Importantly then, why do these external investors really fucking hate this policy, especially when it's imposed by a developing country's government? The first reason is because it seems really intransparent. Because quarterly reports mean you reveal financials consistently, whether they're good or bad. That's the point that closing government refused to believe here. We think this is unlikely to be like lies and tricks for the reasons that I'm mentioning earlier, as in if it's your actual real revenue, and otherwise surely you could do the same lies and tricks for a yearly report, just the same you could with a quarterly one. But yearly reports are perceived as incredibly much less consistent, because you don't see the individual movements of your investments. And this is especially true because investments are often conceptualized on their annual return. So quarterly reports give you some indication of what's happening in the interim year, whereas yearly reports will never give you that information. You're sort of hoping at the end. That means that even if government are completely right, and this policy is a good policy, this policy still seems really intransparent for the investors themselves, because you get much less information, much less of the time. That worries you about what the actual state of it is, because maybe closing government are right, the company that you're investing in, that you have a massive stake in, is in the red, and you have no idea. In developed economies, this is somewhat less of an issue because you have other tools at your disposal. You have more data to actually figure out how the company is doing. But when you're an external investor that doesn't live in that country in which you're investing, it's much harder to do that, and therefore you care way more about transparency. This policy makes you hate it. The second is on government intervention, because the day this policy is implemented, the message is pretty scary. It's imposing all of these things on companies that would otherwise not do those. So you think that they're more likely to make similar types of policies in the future, like more radical capital controls, because obviously they've broken this barrier of imposing it on long companies overall. The third and most important reason, though, is on locking down investments. And this is completely compatible with the OG model and definitions, because they say, it'll only lock down investments for executives. That'll be the only place where minimum holding periods exist. But the largest investors, particularly on the boards of companies that exist in developing countries, sit on the board. So that's because like shares confer voting power, and therefore they actually have the same sort of policy that the policy the opening government describes does apply to them. And that's really important because particularly in developing countries, the like monetary threshold for sitting on the board of a company is probably lower than it is in developed countries. So lots of investors, particularly in like startups in a new place or in like other places in developing countries, are much lower in general. So the external investors are always ones who are sitting on the board and have some amount of voting power or these other types of things like that. And therefore, this does actively directly lock down their investment. So you can't pull out because there's now a governmentally mandated minimum holding period for you in that company insofar as you are an executive yourself. What does that mean then? We think that is a really, really bad thing for the companies for the countries in which that investment happens, because we think you get lots of divestment because foreign investors are much less likely to invest in startups and existing corporations, are much more likely to pull out their existing investment. And this only needs to be a somewhat marginal change for you to believe that divestment happens in a big way, because individual investors are making decisions on the margin, on a 7% return versus an 8% return. And so if they perceive this as something that actually is going to harm their investment in a certain country, they're likely to pull out even if it only changes their return by like 1 or 2%, or even if it's just some sort of imagistic threat. That's the tipping point I was talking about earlier. It doesn't need to be a massive impact in order to get lots of investment from external investors who obviously will hate the idea of this policy, of a government imposing things that gives them less information and forces their investment to stay for longer. And that's really, really bad because external investment is vital for these developing economies, particularly because there isn't enough capital domestically. Because developed countries and developed people, rich people from developed countries are generally much richer than those from developing countries and have more powerful, like stronger currencies that back their investment, and therefore they can afford more in those areas. They also don't have the same incentive domestically to get those returns because it's much less ingrained to actually have the investment culture that would exist otherwise. What that means then is that you need the external investment to actually get companies off the road in the first place. And you need lots of that upfront investment happening from the external investors because they're the ones who make like the physical infrastructure for the company, like the ones who are actually investing lots of money to like open the mine or whatever else exists in that country or open the oil refinery or whatever else. But also that helps to create advanced adjacent industries in those countries, like a financial services industry that actually makes sure that you can have like get the currency in that country and make the investments directly, or like contractors in that country who then do the bidding of the company that you're investing in. Foreign investment dictates the health of companies in in developing countries. This policy really hurts foreign investment, and that means that those companies don't employ as many people, they don't pay wages in those countries, people actually can't get jobs. I think that's the much clearest and strongest impact in this debate, and for all those reasons, I think it's a pretty clear CO.
Great, go for it.
Okay. I'll take POIs in chat, by the way. Let's first explain why opening government's mechanism on individual managers is insufficient in this debate. Even if you are able to incentivize individual managers to make decisions that guarantee their compensations in 7 years down the line, if the entire investment culture surrounding them is still short term, then they just get fired anyways. If Cap Group is still holding period for only 1 year, then they only care about their returns in that one specific year. If discount rates are still high because of the way investment banks work, and there are no holding periods, which is like, it's in the motion, man. Like, come on. Like all of their harms still accrue because you can't just change the incentive of one CEO. CEOs are replaceable and substitutable. And the thing about fiduciary obligations and the beautiful thing about ownership is that I can still fire you even if you are the CEO in the situation where you aren't actively catering to my interests. So what you needed in this debate was an explanation of why defending the actual stronger burden this motion imposes, where we have minimum holding periods, where we make markets more inefficient, sure, is preferable and the world that we should do. That's exactly what Aiden defends when he talks about why we get more long-term investment and why that long-term investment is good. Let's first take out closing opposition in this debate. The first thing they say is that, it happens anyways. Like we will gear towards long-term compensation anyways, and this is only about developing countries. The question to ask is whether companies do this anyways, and I think the answer is not, because companies are still beholden to investors and the horizons they operate on. The problem right now is even pension funds who own individual stocks and equities, but to be clear, like most pension funds hold things like bonds for the most part, operate on relatively short-term horizons. So they don't actually invest in the company for 30 years, because if you've looked at like the market or just any company in the past 30 years, there's very, very few that have lasted that long, which means that holding periods are immediately quite short. And as a consequence, the incentive of the people on the company is also relatively short. But second, I think it's also about norms in financial markets, right? Even in the developed world, norms in financial markets, as per OO's analysis about how high frequency trading and things like that and responses to quarterly earnings are the way in which people are investing has become much more important, means that even if you would do better as a company by investing on things like CapEx now, you choose not to because you want to make sure your fiduciary obligation looks good to those investors. So this debate is still about developed countries. What they do say on developing countries, though, is that people won't invest in developing countries. And I think there's two very simple answers here. The first is that you have no choice, right? Like, I think the reason why people are investing in developing countries is not just because they have slightly better returns, it's because they have better risk-adjusted returns in the status quo. That is to say that the global equity market has seen an over-concentration in the US, and increasingly, like just last week, right, on the Daily Observations, there was an article about the fact that like investing in international markets is just independently good, even if you account for the risk that you take by investing in these areas. And crucially, these markets already are skewed towards the long term because a lot of the investment in these areas is something that will pay out once these companies are able to develop to their fullest. So investors are already less skittish to the quarterly reports that happen in these areas. They're willing to hold for longer because they know their returns will pay off when India eventually becomes a powerhouse. And it's also a way to diversify against the equity risk they hold if they remain in the USA. That's the reason why people invest in countries like India increasingly now. And that reason doesn't go away. And more importantly, like not to borrow OG's response, they have no choice, right? So if that reason still exists and like you invest here, you're still intransparent here, you will invest in India anyways. The second thing I'll say is that there's a trade-off here, right? Like, yes, you get slightly more transparency, but the point is that transparency is also detrimental to you understanding how these investments will pay off in the long run, right? Which is to say that if me having this quarterly report makes me think, like this company has just spent so much on CapEx and they've not done share buybacks, so their EPS is dilutive right now, like I will maybe withdraw my money, even though in a year from now, it will turn out actually that was good CapEx and something that I should have done, which is what Aiden explains to you, right? So the benefit of having this like marginally more transparency, and let's be honest, their claim is fucking marginal. It's about 9 months, 9 months of marginality. It means that on their side of the house, like you know, withdraw money anyway. So it's entirely unclear why this happens. And the conclusion here is that you'll put money into developing countries for other reasons, and the skittishness is actually better on our side of the house. On opening opposition. So the first claim opening opposition has is on hedge funds. And I just want to go through a bunch of reasons why having high frequency trading is bad and like we're okay to impose hedge funds no longer existing, specifically for equity markets in our world. Firstly, high frequency trading and the way it works is like when a normal person buys a stock on an app like Robinhood, that order is often sold to high frequency trading firms like Citadel. 30% of all trades on the day on a 24-hour basis are done by Citadel specifically. And what they do is they'll make like a 1 cent profit on the trade that is done. Now, the problem is that means that I, as an investor, am paying 1 cent more, which hurts retail investors for the most part. And their response here is that, but pension funds invest in hedge funds. Like, this is somewhat true. They also invest overwhelmingly in like other assets like bonds and stuff like that. So the margin they get from diversifying risk using hedge funds is very, very little. The difference, though, is that every other stock now becomes much more expensive when high frequency trading exists. So in a world where high frequency trading doesn't exist, that's probably good. The second thing I'll point out is that they use pretty nefarious tactics that we now kind of take away, right? So things like shorting stocks might sound like a good idea, but the thing is you can also like speculate on stock prices and artificially push them up or down, which is what happened in India, right, with the derivatives market, where like you could just use all your money to pump a stock, buy the options for that stock, and then liquidate. But that screws over the company, which will now see a huge collapse because its stock was artificially inflated. That's exactly the type of stuff that hedge funds do, because that's the type of guarantee they need in order to make their profits. That seems like a much, much worse way in making money. So hedge funds are actually destructive to the efficient market theory because they're not real money, they're hot money. They're money that moves fast and money that is fundamentally inefficient. Martha.
Your benefit relies on companies wanting to do hyper long-term projects but being stopped by investment culture. But small startups, if viable, get angel funding, and large companies cross-subsidize when they're more profitable ventures. So I'm not sure why this motion helps you, nor who the investors are who are willing to take this new
time. So this is the flip, right? Like the point is money going into hedge funds and using these like statistical arbitrages actively crowds out money going towards venture capital, like CG's, like OG's kind of mechanism of 0.9% of money going towards long-term startups. Because I know I can make money by just like trading on the spreads of Argentinian peso, so I will do that. That seems like a really bad idea, right? Because it means that money that is maybe a little bit more risky but would actually go towards long-term innovative projects no longer exists. So hedge funds not only withdraw money from money where it should go, they also do things that are bad, and high-frequency trading screws over people on the bottom and only helps out people on the top. How do we weigh over all of this? First of all, our impacts actually show what types of innovation happen. Opening government says innovation happens generally. We prove one, there's specific environmental benefits that we're able to get, and two, specific types of R&D that is generally positive R&D that is encouraged over time on our side of the house. Second, we show that it is specifically by changing corporate investment culture, which only happens on closing government, that you can actually change the incentives that executives are beholden to, which then leads to the benefits that opening government also wants to access and does so in a more fair way in this debate. For all those reasons, I'm incredibly proud to propose.
Great, Hopweb.
I would also like POIs verbally, please. I'm going to respond to GovBench, then I'm going to weigh out Cyrus's case above opening opposition. What happens on GovBench? I think the problem with GovBench is they characterize executives as slaves to quarterly reports. Fundamentally, even though they say they don't, this is what they do. They need to demonstrate short-term profits in order to do things like dump stock auctions in order to get the benefits that GovBench say they're relying on in the first place. And shittification only works because the imminent line goes up and the long-term line goes down, but you can only communicate that your imminent line has gone up by your public earnings reports. There's not really another way to indicate the fact that you have substantially increased profit in the short term. And in order to benefit from this, you have to have something in which you're demonstrating it. Because, like closing government says, these public earning reports are what change investors' behavior, change investors' strategy, and change which companies they are investing in. Which means that in the absolute best case for government bench, they increase the optimal turnover timeline to 1 year instead of 3 months. But the problem is this is actually just not enough time for the scale of impact they want to change. So the best case scenario for GovBench is maybe that executives go to 3-year timelines, except closing government explains why they can't do this. If the 3-year timeline is in the red, investors pull out and the company cannot function per closing government analysis. So they actually lock themselves into this 1-year timeline that's modeled at PM, which I think is probably bad for them because I think it substantially mitigates their impact. And I think that it means that realistically, they can't access a lot of the long-term R&D benefits that both GovBench teams are attempting to claim because they rely on tipping point analysis here. I think that it is just fundamentally true, you need a certain amount of time in order to access the benefits of research and development, and that amount of time is almost always longer than 1 year. In order to get the benefits of these long-term infrastructure projects, for example, you have to have the factory up and running before you submit your next quarterly or your next annual earnings report, or else you're not going to be able to get the benefits of having that profit, and you're still going to be in the red the next time you turn in a quarterly report.
On that.
Which I think means that they are unable to get the benefits of their analysis to the extent that they think they are, because they can get maybe a little bit more long-term incentives, but at this point it's become fairly marginal and it's relatively unclear where precisely the tipping point is. Closing government has a slightly different path to access this, although I think that it's somewhat reliant on their opening. And the reason that I think it's somewhat reliant on their opening is first, I do think you have to disregard mechanisms that are reliant on the model, insofar as I think that are reliant on an alternative model, which I think is the problem. Because closing government has the path to victory. At the first minute of Aidan's speech, they say that this creates a shift in investment culture. But the mechanisms they provide here means that this doesn't manifest without the corrected model that they provide in closing government, which they can't do because the model was not challenged in LO. You can't change the model by the point we get through 3 speeches of this debate. The only mech here is that investors have to hold for the minimum period, and therefore this creates this shift in investment culture. But insofar as I'm not sure they actually prove any degree of delta on this, maybe they have the most marginal delta in the world in terms of maybe this causes some form of signaling effect, and maybe some people are a little bit more willing to hold things a little bit longer. And there was like somewhat more risk tolerant. But I just don't think they actually prove this per the analysis that's given in both speeches, which means that this turns into a weighing game against Cyrus's case, and I think that weighing game is probably going to us. Why is that true? Because Cyrus's case is fairly simple. Some companies do this anyway, and the response we get in GovWhip is insufficient here, right? Because I think that it is true that some companies have longer horizons. Because yes, they're obliged to the short-term investors, and they're obliged to the short-term quarterly reports that require the line to go up every single time. But the board itself is long-termist. In fact, every team in this debate, other than us, gives examples of investors who are substantially invested in these companies, who provide quite a lot of their capital, who provide quite a lot of their running potential, that are long-term investors, which means that the board needs to balance the incentives between these short-term investors and the short-term quarterly reports. And they know that these short-term quarterly reports could cause bad behavior by their executives. And so they do things like impose some of these policies by themselves, which means the debate only happens about companies that are not already doing this. And companies that are not already doing this have a fairly good reason to not already be doing this. Just empirically, this is just true. Like my dad gets paid in 3-year timelines, and so he doesn't actually get an annual salary. He gets a 3-year salary, and he doesn't get his bonus if he quits in that time. But I also just think that this is the AIV probably knows that there are a substantial amount of controls on executive salaries and executive timelines in order to mitigate this. Except in some places. And those places are the places where the debate matters. Before that, I'll take the POI from opening.
In private markets, valuations change infrequently, which generates very little panic and in fact makes it easier to focus on long-term profitability. Why can't even those places just work more like private markets?
I think that it's because of the analysis Cyrus has already given in his speech, largely. Because I think that the thing is, perhaps people who are willing to invest in developing economies are a little bit more risk tolerant, but they're not actually so much more risk tolerant that they're willing to do this. Because the reason that they're risk tolerant in the first place is because of two things. The first one is they feel as though they have transparency. So they feel as though they can make a good decision about which developed economy to invest in. Because it is true that perhaps developed economies are on average a safe bet, but it's not true that every developed economy is a safe bet. For example, at the moment, I think it might not be the cleverest idea in the world to invest in Sudan. And probably everyone knows that. But there are some places where you do not know about what's happening on the ground. You don't know about how cash flow is changing. You don't know how investments are panning out. And you don't know about the most recent UN report that says that infrastructure is actually an environmental disaster that means that bridge is going to collapse in 3 years' time. I think that transparency comes via these earnings reports that happen fairly frequently, which is the first reason that these people are willing to do this. The second mech, which goes entirely unresponded, is probably the more important one because it operates most cleanly under opening government's frame, but also under everyone else's frame as well. So whether or not you buy the definitional challenge, this still works. These investors feel as though they can pull out at any time. But the problem is they can't pull out at any time whenever they are executives of a company that has bought another company, and this company doesn't have the capacity to dump it under the opening government model. But they also don't have, individual investors also don't have the capacity to pull out at any time under the secondary GovBench model that exists, because you have these minimum holding periods that hamstring your ability to get rid of bad investments. The weighing here is simple. Maybe they are able to improve the developed world a tiny bit. Maybe they get a tiny bit more long-term projects. But on our side of the house, we have jobs for people in the developed world who otherwise go hungry.
Great. Thanks everyone for the debate. This is a closed round, so you will find out the results after the break announcement. Good